Hey, it's Rick. It's Thursday, November the 14th. We had a massive update today following the release of the Consumer Price Index report this morning. The market, I have the small caps as represented by the Russell 2000 on the chart in front of me, and you can see it gapped up here right from the get-go, and then just marched straight higher all day long and closed right at the highs, and all of this on massive volume. So obviously a lot of short covering, but institutions have stepped in and really started to buy. A couple of interesting observations. Look at the QQQ. We've been in this downtrend for most since last July, August. We came out of it last week. Kind of thought it would roll over and come back and form a new high and then get up here again. But instead, no, we just ripped right high, straight up. And we're within a snick of regaining the 52-week high, which would be an all-time high, which is quite something. And this strength is being driven by of course, what we refer to as the Magnificent Seven. Because if you look at this chart and compare it to the equal weight QQQs, you see quite a different picture. It's still arguably was in a steeper downtrend. We gapped way out of it today, which is a super bullish sign, but we are really a long ways. What's that, 77? We're still another 5% away from the 52-week high. So, but that is kind of interesting. Same sort of story on the S&P 500. Today, the massive gap up. we're getting a lot closer to the 52-week high. But when we look at the equal weight RSP, which is the one I favor, I'll come back to all of these arrows in a little bit, but we're still a long ways away from 52-week high. But again, though, this is a very bullish thing. A big gap up today, and then constant buying all day on massive amount of volume. So this is good. The other encouraging thing for me is, to my eye at least, I'm gonna pull this back down. This is the S&P 500, or the equal weight S&P rather. And this is a chart of the stocks that are trading above their 40-week moving average on the New York Stock Exchange. And if I roll this back, I talked about this one a few weeks ago. When we get down to these low readings, back here in October 2022, we only had like 8 or 9% of the stocks were trading above their 40-week moving average, which is like means 92% of them are trading below it. And generally that can signal the bottom. And sure enough, in this area here, if you compare to the price, we did get a blip up. Now it wasn't sustained, it didn't last very long, but you get I think I talked about this one in the previous videos. So again, here was a low period, and then followed by a good rise in the S&P. Here we got down again to around 12%. The rise was a little bit more muted, but at least it did come up off that. And I think it was about here or here, I can't remember, in early October I talked about this. And sure enough, we've come off these lows. So this is sort of a contrarian indicator when you're really overbought or oversold. So we got a long ways to go before we get back up to like 70, 80% of 75% or so of the stocks trailing or trading above their 40-week moving average, before I'd be really concerned that we're into an overbought situation and we'd be ripe for a turnaround. So this just tells me the market has got a lot of breadth to it. It's not just contained by a few stocks. And it also tells me that I think we got a ways to go. So going back to the RSP, and what do? So previous aha moment video I had a couple of weeks ago, I came up with the, spread this out a bit, these sort of market indicators and the strategy, what to do, how much to get invested, how much you can risk on each trade when the market conditions are either red, orange, yellow, or green. And we've been in this sort of orange or red environment and yellow environment for many, many months now. And the aha moment for me has really got reinforced in the last 2 weeks. In this period here, where are we? September. In September and into mid-October, my win rate was around 30%, 28% actually, which is not surprising considering I'm fighting this really poor market conditions. And what I failed to do was adjust my my risk amounts depending on what the condition was. Well, we're still in an orange-yellow environment. We were until today. Today we turned green. So, and green, I put it as a light green because while we're above the 10-day moving average, we're above the 20. The 20 is arguably starting to tick up. The 50 is still trending down. So I'm not going to get, while we're in a green environment, I wouldn't get uber aggressive here yet until this moving average starts to at least flatten out or maybe start to head back up, which will probably take another week or so. And then I'll get much more aggressive. But the difference is since the 1st of November, when we get into this more attractive environment, my win rate all of a sudden has gone to 50%. And that's not counting 3 open trades that I have, 2 of which are guaranteed to be profitable. And 1 is profitable, but my stop is still at break even. And so, and this is what you would expect when the market conditions are favorable. My trading strategy, my entry strategies aren't much different. But you expect that you got a bit more wind at your back and you're going to have a 50, 55, 60% even win rate, and which makes a huge difference in the P&L. My average win for the month of November compared to my average loss is running a little over 3 times. So again, that's exactly where you want to be. So to put this in context, you know, I used the example in one of the videos of, say, a $100,000 portfolio. When you're in a yellow environment, you when you're in a yellow environment, you only want to be risking. What was my math on here? Yeah, 0. And let's see how I can draw this. 0.125%. This is a real test of my writing skills. 0.125%, which on a $100,000 account means basically you're only risking $125 into a maximum of 0.25%. So decimal 25, so 250. So again, whereas I point out, I think I pointed this out in my memo, in my email, your risk amount is really kind of tiny. We're really not trying to make any money in this kind of environment, but we're still sort of keeping our finger in the game. And so if you do experience like I did here, you know, with only a 28% win ratio, it means I'm losing 62% of the time. Had I been following this precisely, my losses would have been much smaller than what I actually experienced. So now that we get into a green environment, though, and this is where we get some asymmetrical leverage, is my risk amount now per trade is going to go from 0.5% up to 1.25%. So to put this in terms of a hypothetical portfolio of $100,000, now my trade risk is going to be from $500 at the low end, which I will entertain starting tomorrow if I enter any new trades. It's going to be hard to get some setups with this kind of a big move, but if things do set up, I'm not going to have full conviction yet because I think we're going to pull back a bit. But anyway, that's not a whole nother story. But my risk amount is going to go from $500 up to $1,250 for a $100,000 account. So now, if I'm achieving, as we should in a green environment, a 50% win rate and a 3-to-1 reward to risk ratio, you can see here where it doesn't take you very long and you get huge increases in your equity curve. So, and then you sustain that until things turn yellow again, and then you just drop right back to basically tiny amounts of risk. So this is sort of my aha moment that I experienced a couple of weeks ago. That is all of a sudden really showing me in real life that this is the strategy, the money management strategy that I think is important to follow. So that's that part. Just where do I think we're going to go? I'm going to have a quick look at, go back to the S&P 500. So again, we jumped out of this downtrend line. We're here. We're up near the all-time highs. If you're an index investor and you're not fully invested, and now the market conditions suggest green, I wouldn't go jump all in right now. I think there's a high probability we're going to mush around in, we're going to mush around in here for a bit. And so I'll draw a couple of scenarios here, a couple of lines of importance. So to my eye, when we had this move up here, we had a first pullback to this area here. And then it rose again into the end of July. And we pulled back right to this same area. So that obviously became this general area in here, which I will draw. I can find the right tool. So this general area in here is what I would call, this area was support, continued to be support, and then we crashed through it. We came up, we tested this area again, and it's a little wider here, but I mean, these are just areas of interest, but it's never a precise price. But then it couldn't hold it, came down, came back up into this area of what is now a resistance, mushed around a bit, and it's now plowed through here. So I think, so this is, to me, to my mind, this is sort of the downside risk. This is like, I can't see us going over the next few weeks. If we do go down, it's going to come down into this area in here. On the other side of things, here we got this all-time high to contend with. So I think that's gonna form some formidable resistance too, because especially when you look at this move from down here at the beginning of the end of October, from here to here is a huge move up. And so a lot of institutions, hedge funds, whatnot, especially if this happens before year end, they're gonna bank their profits, and we're gonna see some pressure in here. So I see this going forward as some sort of a range for the major indexes. So if we're sitting here, there's an equal probability of here as opposed to here. So, which is why I'd say I wouldn't get uber aggressive in here until we get signs of a much better lower risk entry. That's from an index perspective. From a stock perspective, as long as we're in here and we're staying above these moving averages, we're going to get a lot of stock setups, and there's going to be a lot of opportunity to get into stocks that that will run 30, 40, 50, even 100% over the next 4, 5, 6 months. So I'm getting uber bullish on that. So that's that. I do have 3. I'll just quickly go through the 3 positions that I do have. First is this DAKT. I entered this, I can't remember the exact dates. I got my first entry at 9:67, so it was in this day here. I added to it at 9:35. Yesterday, when it came back inside here, I added some more, and I've been nicely rewarded today. This is now up about 12%. So I took a little bit off the table. I still have about 2/3 of my position, and if it does pull back into here, I maybe give me another entry to add to this position again. This has I won't belabor all of the fundamentals here, but enormous growth potential. Their earnings last year grew by over 2,000%. They're forecast to grow another 40% this year. They still only trade at a PE ratio of 9, and got a lot of things going for it. So this is going to be, I consider, a core holding. FTI is an oil field service company. I think I talked about this one, buying it off the bounce off the 50-day moving average. It's struggling a little bit in a strong environment, so I've taken off 2/3 of this already, and my stop is up here about 50 cents more than what I paid for it. So I'm guaranteed to be a profitable trade here. It may, if oil comes back, it may continue to give me another entry, but right now I'm content with this one. And here I took a small opening position in a semiconductor company. Let's just spread this out. Came down here, up to here, down, tested it again, came down shallower, and then has been bouncing around right at the $57 area. I took a little bit early entry in here, and we got nicely rewarded today, and my stop is at break even. So this one, fundamentals are not fantastic, but it has a good chance to run up in here to the mid 60s. So that's what, 12, 13, 14% or something. Anyway, that's it for today. And so I'll give you another update maybe later in the week. Cheers.